What if I told you there's a Singapore stock that gives you indirect exposure to 500 million people across Southeast Asia, pays a 4.4% dividend, has almost wiped out its debt, and the market is pricing in zero growth? That's Jardine Cycle Carriage, ticker C07 on the Singapore Exchange. Today I'm doing a full deep dive. Business model, competitive moats, the financials, the risks, and what I think the stock is actually worth. Grab a coffee, because there's a lot to unpack. A quick disclaimer before we get into it. This is not financial advice. Everything I'm sharing today is my own research and opinion for educational purposes. Always do your own due diligence before putting your hard-earned money into anything. So what exactly is Jardine Cycle Carriage? At its core, it's a holding company. Think of it like a fund. You buy one Singapore share and you get exposure to Indonesia's largest conglomerate, two fast-growing Vietnamese businesses, and a network of car dealerships across Singapore, Malaysia, and Myanmar. The parent company, Jardine Matheson, one of Asia's oldest trading houses, owns about 78% of JC&C, and JC&C in turn owns 50.5% of PT Astra International, listed in Jakarta, which is really the engine of the whole thing. The Vietnam portfolio includes a 26.7% stake in THACO, that's Truong Hai Group, one of Vietnam's largest auto assemblers, and a 41.7% stake in REE Corporation, a diversified infrastructure and renewables business. Then there's a cycle and carriage dealership network in Singapore and Malaysia, handling premium brands like Mercedes-Benz. To understand JC&C, you have to understand Astra. And Astra is not just a car company. It's basically the backbone of the Indonesian economy. When someone in Jakarta buys a Toyota, a Daihatsu, or a Honda motorcycle, there's a very good chance Astra was involved in making it, shipping it, selling it, and financing it. It operates across 6 major segments. 1. Automotive and mobility. Astra assembles and distributes Toyotas through a joint venture called Toyota Astra Motor, Daihatsu through Astra Daihatsu Motor, and is a distributor for Honda motorcycles. In a country of 280 million people, Honda motorcycles are basically the bicycle. 2. Financial services. When customers can't pay cash, which is most of them, Astra's own finance companies step in. Federal International Finance for motorcycles, Astra Sedaya Finance for cars. Captive financing is a beautiful business model. 3. Heavy equipment, mining, construction, and energy. This is United Tractors, Astra's separately listed subsidiary, which holds the exclusive rights to distribute Komatsu heavy equipment in Indonesia, plus a massive coal mining services business. 4. Agribusiness. Oil palm plantations through Astra Agro Lestari, listed on the Jakarta Exchange. 5 and 6. Infrastructure and healthcare. Toll roads, logistics property, and an expanding bet on healthcare through hospitals and Halodoc, Indonesia's leading health tech platform. Add it all up and Astra's net income for FI 2025 was IDR 33 trillion. That's roughly $2 billion US. This is a massive business and JC&C owns half of it. Here's something I think a lot of retail investors miss about Astra's model. It captures value at every single link in the chain. Upstream, you got Toyota, Honda, Daihatsu, Komatsu, global giants who need a local partner with distribution, regulatory know-how, and decades of customer relationships. Astra is that partner. They have been for 50 years. They assemble the vehicles locally, so they capture manufacturing margin. They sell through their own dealer network, so they capture distribution margin. And then, critically, they finance a purchase through their own captive lending companies, so they also capture the financing spread. And the reach extends outward. Astra's own network, plus partners like Tunas Ridean in Indonesia, Cycle and Carriage in Singapore, and THACO in Vietnam extend that distribution footprint across the whole region. It's a genuinely integrated value chain from factory gate to customer driveway. Let's look at the numbers. JC&C reports its key earnings metric as underlying profit attributable to shareholders, stripping out one-off gains and losses to show you the real business performance. In 2020, COVID hit hard. Profit crashed to $429 million US, the lowest in over a decade, as lockdown shuttered showrooms and halted factories. Then came a recovery. 2021, $786 million US. 2022, $1.1 billion US, a new record. 2023, $1.16 billion US, another record. 2024 and 2025 both settled around $1.1 billion US as Indonesia softened. The dividend tells a similar story. It was cut to just US 43 cents during COVID, then rebuilt strongly year after year. 80 cents in 2021, 111 in 2022, 118 in 2023, and a record 113 cents in 2025. If you bought this stock at the depths of COVID and just held, you got a 21% dividend CAGR over 5 years, and the stock delivered a 34% total shareholder return in 2025 alone. That's not bad for a so-called boring conglomerate. The FI 2025 headline looks stable. Underlying profit of $1.11 billion US, up 1% on the year. Revenue at $21.4 billion US. But to understand what's actually happening, you need to look under the hood. Indonesia, which is 83% of the portfolio by shareholder value, was the weak spot. Astra's contribution to JC&C's profit fell 7% to $927 million US. 2 reasons. The Indonesian car market contracted sharply, with Astra's own car sales falling 15% to about 409,000 units in 2025. And the Indonesian Rupiah weakened significantly, which means even stable Rupiah earnings look smaller when translated into US dollars. Vietnam was the bright spot. THACO jumped 41% to $55 million US. RE was up 37% to $41 million US. Combined, the Vietnam segment was up 25% to $129 million US. Singapore, the cycle and carriage dealerships, was resilient, growing 50% to $48 million US, driven by strong sales of Mercedes-Benz models. So the headline number looks stable, but underneath, there's a clear story. Indonesia challenged, Vietnam accelerating, Singapore solid. In 2025, JC&C stock was basically a tug-of-war between two opposing forces. On one side, the Indonesian Rupiah hit record lows near IDR 17,600 to the US dollar. That's a significant headwind, because Astra earns in Rupiah but JC&C reports in US dollars. And Indonesia's car market posted its worst year in recent memory. On the other side, management was quietly doing all the right things. They sold their stake in SCCC, Siam City Cement, for $344 million US. They trimmed their Vinamilk position for over $200 million US. They sold half their Toyota Motor stake. All up, they raised well over $500 million US from non-core assets, and every dollar went to paying down corporate debt. JC&C's own corporate debt fell from $1.3 billion US in 2023 down to $577 million US by end of 2025, a 56% reduction in just 2 years. And both Astra and United Tractors have been running active share buyback programs, which mechanically increases JC&C's effective stake in Astra without JC&C spending a single dollar. Now let's talk about what makes Astra genuinely difficult to replicate. If you're paying 10 times earnings for something, you need to be confident the earnings don't disappear. Moat number 1. 50 years of exclusive OEM partnerships. Toyota, Honda, Daihatsu, Komatsu. These relationships were built over decades. They're not just distribution agreements. They're integrated manufacturing joint ventures with aligned incentives and institutional trust that a new entrant simply cannot buy. 50 years of part supply chains, trained technicians, and co-invested assembly plants don't just walk out the door. Moat number 2, captive finance. When you buy a Honda motorcycle in Indonesia, there's roughly a 1 in 3 chance that Astra's own finance company, Federal International Finance, did the loan. That's not luck. The dealer recommends the in-house lender every single time. That's a structural competitive advantage baked into the distribution channel. Moat number 3, United Tractors' exclusive Komatsu rights. If you're a coal miner in Indonesia and you need a Komatsu excavator, the global standard for mining equipment, you must go through United Tractors. And once you're running a fleet of Komatsu machinery, you need UT service network, spare parts, and maintenance teams. The switching costs are enormous. Compare that to the competition. Zhongxin Group, a large Chinese auto dealer, recently swung to a net loss, with return on equity turning negative. Tan Chong Motor Malaysia has been losing money every single year for the past 5 years. Against that backdrop, Astra's consistent billion-dollar profit and 15%, plus return on equity looks very different indeed. Indonesia's auto market sold about 409,000 cars in 2025, down 15% from the year before. And I know that sounds alarming, but here's the context. The historical run rate for Indonesia's car market was closer to 1 million cars a year. Indonesia has 280 million people with a rapidly growing middle class and very low vehicle ownership per capita. So either Indonesia's middle class permanently stopped buying cars, or this is a cyclical dip that eventually reverses. I think it's the latter. The structural tailwinds remain intact. Indonesia's GDP is growing, urbanization continues, and the government is investing heavily in infrastructure. Short-term headwinds, elevated interest rates, rupiah weakness, cautious consumers, are temporary. And here's an angle that doesn't get enough attention. Indonesia is sitting on the world's largest nickel reserves. Nickel is a key component in EV batteries. Astra is already positioning itself right in the middle of the EV supply chain, with investments in nickel mining through United Tractors and through a 6% stake in ASX-listed Nickel Industries. So the company that dominates Indonesia's combustion engine market today is hedging into the EV transition from the raw materials end. That's smart positioning. 2025 brought a meaningful governance milestone. JC&C appointed Samuel Chin as its first ever independent chairman. That's a positive signal. It suggests the board is taking minority shareholder interests seriously, not just those of the Jardine Matheson parent. The capital allocation track record, on balance, is solid. The Permata Bank exit in 2020. Astra sold its 44% stake for $1.1 billion, was excellent timing, and the proceeds were redeployed well. The dividend CAGR 21% over 5 years speaks for itself. The one notable miss is SCCC Siam City Cement, which was written down 3 times over 4 years and eventually sold at a loss in 2024. Not catastrophic in the context of a $1 billion earnings business, but useful reminder that conglomerates don't get every bet right. Now the risks, because no investment thesis is complete without them. Risk number 1, and this is the biggest, is the Indonesian Rupiah. Astra earns in Rupiah. JC&C reports in US dollars. When the Rupiah depreciates, Astra's profits look smaller in US dollar terms, even if the Indonesian business is perfectly healthy. At IDR 17,600, we're near record lows. This is a translation risk, not an operational risk. But it's very real for US dollar or Singapore dollar investors. Risk number 2, the $3.9 billion of debt sitting inside Astra's financial services subsidiaries. Management excludes this from their headline net debt figure, and that's defensible because it's structurally similar to a bank's funding liabilities, matched against a consumer loan book. But it is real debt. It's been growing steadily year on year, and it deserves to be tracked. Risk number 3, EV disruption. Over a longer horizon, if electric vehicles penetrate Indonesia's market faster than expected, Astra's combustion engine assembly economics could be pressured. Management is investing ahead of this. Nickel healthcare infrastructure, but the transition timeline is genuinely uncertain. Let's put JC&C's valuation in context. JC&C today trades at about 10.6 times trailing earnings, with a 4.4% dividend yield and a 5-year average return on equity of around 14%. Astra itself trades at roughly 7.8 times earnings on the Jakarta Exchange and yield about 6%. Remember, JC&C is a 50% owner of Astra, but also carries corporate overhead. So a premium to Astra's multiple makes sense. Jardine Matheson, the parent, trades at a richer 20 times. Earnings, partly reflecting its broader global asset base and the added layer of holding company structure. United Tractors, which Astra controls and which JC&C indirectly owns about 31% of, is at 6.6 times and yields over 7%. That's quite cheap for a business with an exclusive Komatsu franchise and a 5-year average ROE of over 21% versus the direct competitors in auto distribution. JC&C is in a completely different quality league. Zhongxing, recent net loss, ROE negative. Tanchong, loss-making for 5 consecutive years. Sime Darby is the most comparable, diversified Southeast Asian conglomerate at around 6.4 times with 6% yield. So on a pure multiples basis, JC&C isn't screaming cheap, but it's not expensive for quality. Now here's the really interesting part. Let's talk valuation. I started with a look-through calculation. JC&C's 50.5% stake in Astra, based on Astra's current market capitalization of about $15.6 billion US, is worth roughly $7.9 billion US on its own. JC&C's total market cap is about $9.4 billion US. So you're effectively paying roughly $1.5 billion US above the Astra stake value to also get the Vietnam businesses, THACO and RE, plus the Singapore and Malaysia dealerships. Is that $1.5 billion US premium reasonable? Well, THACO contributed $55 million US in FI 2025 and is growing. RE contributed $41 million US and is growing even faster. Singapore added $48 million US. That's around $144 million US in annual earnings for the non-Astra portfolio. 10 times that is $1.4 billion US. So you're not paying a crazy premium for those assets. Then I ran a reverse DCF, which is basically asking the market, at today's price, what growth rate are you baking in? And the answer is approximately 0. The market is pricing in no real earnings growth for JC&C over the next decade. Now, is that realistic? Indonesia's auto market is at less than half its historical run rate. The Rupiah is near record lows. Vietnam is growing. JC&C's corporate debt is falling fast. My base case is 4 to 5% annual earnings CAGR as Indonesia recovers cyclically and Vietnam compounds structurally. That gap between market pessimism, 0 growth price in, and a realistic base case of 4 to 5% is where the opportunity lives. It's not a deep value screamer, but it's a very solid risk reward for a quality compounder paying you a 4.4% dividend while you wait. So where does all of this leave us? JC&C is a high-quality dividend compounder. It has durable moats, a well-covered and growing dividend, rapidly falling corporate debt, and indirect exposure to the most populous economy in Southeast Asia at what looks like a cyclical trough. But at SGD 33.13, the margin of safety isn't quite there for a full position in my framework. So my verdict is pass. Monitor. I'd want to see one of two things before committing capital. Either the price pulls back to around SGD 29, which would give me roughly a 30% margin of safety on my intrinsic value estimate, or I want a clear sign that Indonesia's auto market is recovering, because that's the single most important fundamental catalyst. The specific triggers I'm watching: Indonesia car sales recovering above 450,000 units per quarter, the rupiah stabilizing below IDR 16,000 to the dollar, or the stock pulling back on a general emerging market sell-off, which sometimes gives you the same entry at a discount with no change to the underlying business quality. Let me leave you with the 5 things I'll be watching on JC&C. 1. Indonesia auto volumes, the single most important leading indicator for Astra's core earnings. A sustained recovery above 80,000 cars per month is a meaningful green flag. 2. Rupiah stability. If Bank Indonesia gets inflation and capital outflows under control, and the rupiah strengthens back toward IDR 15,500, that's a direct tailwind to JC&C's U.S. dollar earnings without the business changing at all. 3. Vietnam profit growth. THACO and RE are the next growth engines for this portfolio. I want to see THACO's real estate revenues compounding and RE's power generation pipeline converting into earnings. 4. JC&C's corporate debt trajectory. We're now basically at 0 net debt at the corporate level. The question is what management does with that financial flexibility. Buybacks, more dividends, or new investments. 5. Astra's EV and healthcare bets. There's roughly $550 million US invested in Indonesian healthcare. Hospitals, Halodoc Cardiovascular, And United Tractors just signed to acquire a gold miner for $540 million US. These are early-stage strategic bets that could re-rate the stock when they start generating meaningful profit. I'll drop a link to the full deep dive report in the description below if you want all the numbers, the financial model, the peer comparison tables, the look-through valuation. If you found this useful, hit like and subscribe, and let me know in the comments. Are you bullish or bearish on Southeast Asia right now? I read every single comment. This is not financial advice. Do your own research. See you in the next one.